The secrets to successful trading are hidden in plain sight, yet they will continue to elude almost every trader who attempts to make money from financial markets. These secrets are not really even secrets. The truth of trading is just so deeply buried under mountains of nonsensical distractions that it seems hidden. 95% of all traders are reaping the negative consequences of losing money because they have not taken the time to stop and see what this business really is and how it really works. In this video, I'm going to show you the very few things that you actually need to master to become profitable. And when this video is over, you too will understand why almost everything else is absolute noise. Understand what a trader really is in order to do the job properly. A trader in reality is a middleman, and a successful trader operates as an expert middleman first and a speculator of price second. The trader's job is to insert himself in between other traders' transactions and make a profit in the process. A successful trader does his best to make sure he has a willing buyer lined up at a better price before he ever gets involved in a market. This ensures he has the best chance of making a profit built into every trade.
I got a one out of Blue Star. You want to make a trade? I know the boys down at Morgan are buying Blue Star like crazy right now. I'll take it off your hands.
Most traders make the mistake of focusing on only what they want to happen, rather than making sure everything is in place the way it needs to be in order to have a successful trade. What this means is thinking about who you are going to sell your inventory to at a profit before you ever get in. Thinking about the market in this way is the starting point of creating a repeatable, profit-generating approach. It is no different than opening a shop on a busy street, knowing there will be plenty of foot traffic to come buy your products. Opening your business in this location with guaranteed customer traffic would help ensure that your business will be profitable before you ever make the investment in setting it up. Getting into a trade and not knowing who will be your exit liquidity is like opening a shop on a rural highway that is rarely traveled. You may get a few customers here and there, but nothing you can consistently count on to support your business. While as a retail trader you do not have the need for liquidity or have the restrictions the banks do, you do well to remember that they are the ones who move the market. And if you want to predict which way price is likely to go next, you would be wise to study how the banks need to transact in order to make the returns that they have promised their investors. Since traders today operate from all over the world and trading mostly happens through electronic gateways, an updated model of demand forecasting needed to be constructed that would simulate the higher level of certainty that trading face-to-face in tight-knit circles had in older times. This leads to the second thing you need to understand to trade profitably. The best model available to predict the future direction of price, other than having insider knowledge, is through multi-timeframe analysis. Future demand and liquidity can be projected by thinking about different timeframes as individual investor types. Remember the needs of the ones who move the market. They need enough opposing volume to fill their inventory storehouses. This requires a well thought out execution process to do it right. But if the bank wants to accumulate the majority of their positions at a good price without moving the market out of their favor, they need to buy inventory as stealthily as possible in smaller amounts. This all takes time, which is the reason we developed the following framework to help you understand institutional intent. Timeframes below the daily chart represent shorter-term traders looking to capitalize on daily price swings. Timeframes above the daily represent long-term traders looking to move larger amounts of capital over time. Each type of trader relies on the other to trade the way they need to trade. Short-term traders need long-term investors to move and stabilize prices. Long-term investors need short-term traders to create on-demand liquidity to fill their positions when they want to get in and out. Together, they make a perfect ecosystem that accommodates both trading styles. In order to trade successfully, you need to decide where you will fit into this ecosystem. You can do this by following this sequence. If these things are not in place, every trade you make can be little more than a gamble. Step 1. Decide on your timeframes you want to use to view the market. Understanding what timeframes to use comes down to deciding what time horizon you personally want to trade on, and then aligning with the higher timeframe that will support your institutional needs analysis. In short, pick a timeframe you will personally accumulate and distribute your own positions on, and a higher timeframe that supports your overall market direction and future price predictions. Recommended timeframes for day traders are the 5 or the 15-minute into the 4-hour. Recommended timeframes for intraday swing traders are the 30-minute into the daily or the 4-hour into the weekly. Longer-term investors will be best suited with using the daily paired with the monthly or the weekly paired with the 12-month chart. Step 2. Apply the 3 market phase framework to your higher time frame. The 3 market phase framework is the most accurate model you can use to predict volatility coming into a market, as well as map out the points of interest from a bank's perspective. Once you have mapped out the 3 market phases on your higher time frame, you then want to look at that chart and ask the following questions. What phase is a market clearly in? How would a bank or institution that needs to make a return on a large sum of money look at this market? Can I see any instances of blatant stop running above or below prominent highs and lows? Have the markets already started to trend and I am now late? These are the types of questions that will help you understand what it is you should be doing and whether a market is ready for you to get involved or not. Step 3. The last step is to time your involvement in the market. The following is the most accurate model we have found for defining directional bias and following a trend. First, you wait until your higher time frame has started its expansion phase. This guarantees that you will have a minimum amount of volatility coming into the market and prices won't go flat on you. Second, start tracking price inefficiencies within your higher time frame candles. You can do this by looking for the classic 3-candle inefficiency gap or the group inefficiency model taught by us at Trade ATS. Look for the first instance of an up or down inefficiency. This is how the banks kick off a new trend and how you get grade A trade placement. And third, find your first instance of fair market value within the new trend and position yourself above or below that value counter to the trend direction. By doing this, you are giving yourself the very best chance of being early to a new trend and entering the market with a very strong, easy to defend position. Do this over and over, and you will not need to worry about finding good trades ever again. This leads us to the third thing you need to know to become profitable. Become an expert at valuing markets. When you think of overvalued or undervalued markets, what may come to mind is the Benjamin Graham style of understanding market valuation. He taught that in order to value markets, you need to analyze a company's fundamentals like earnings, assets, and dividends to estimate its true value. He looked for stocks trading below this value, offering a margin of safety to reduce risk. While this is a proven, successful approach to long-term investing and should not be discounted, we have come up with a way to apply the same type of investing logic using low time frames and nothing more than mass market psychology and price action. This again starts with the framework of the 3 market phases. In the contraction and expansion phase, we can define what is the most recent fairly valued price. We do this by understanding that in order for a market to contract, you need a balance in supply and demand. A natural byproduct of balanced supply and demand is a fairly valued market. This happens because both buyers and sellers have agreed upon price, even if for only a little while. From this balance point comes a technical and psychological pivot point we can use to judge whether a market is overvalued or undervalued at any given moment, which leads us to the next major thing you need to understand in order to become profitable in trading. Understand the role pain and pleasure play in the market. At the most basic, primal level, humans are driven by two instincts: to retreat from pain and to go towards pleasure. The markets are a grand example of these two forces working at their best. In life, when we experience pain, our immediate reaction is to make it stop as fast as possible. A simple example is when we burn our hand on a hot stove. As soon as we realize we're getting burned, we immediately withdraw. Pain causes us to want to take immediate action. In life, when we experience pleasure, we get lost in it. We want it to continue as long as possible and do not want to do anything that may make it stop. Pleasure causes no action. The reason traders consistently lose money can be summed up in the following statement. Traders take immediate innate action when in pain or they're losing money, and do not take decisive action when in pleasure or profit because they are wanting to see how much more money they can make. If you combine these two natural instincts with the fact that most markets range 90% of the time, then you'll begin to understand that during the life cycle of each trade you take, you will likely experience some level of drawdown or pain. Most traders are not prepared to experience this drawdown, which is why they book losses over and over again. The amount of pain you experience in drawdown is directly correlated to the amount of size you are trading, relevant to your overall account value. The bigger the size, the tighter your pain threshold will be, and the more likely you will be to book a loss. Large trade size and small stop losses are the biggest reasons for the countless small accounts lost to the market. The way to solve this problem is to first understand that it exists and plan your trades and your money management to accommodate your pain threshold. When you get into profit, this is where you need to take decisive action. You do not want to be the trader who saw a large paper profit only to watch it come all the way back down to break even, or even worse, a loss. They too fall victim to their pain threshold as their paper profits vanish before their eyes, causing them to take decisive action again in a pain state. In this video, you've been exposed to many eye-opening concepts, but this is just the tip of the iceberg. If you want to go deeper, go to tradeats.com and enroll in our free Master Pattern Academy. It's an 8-hour course that goes deep on the concepts that we've touched on here. Also, make sure to check out the rest of our content on YouTube. All of our videos build on the topics that we've discussed here. Until next time, trade well.